Alibaba just reported earnings and the stock took another dive. Shares are now down 75% from their all-time high, and the stock is lower than its first ever day of trading back in 2014. Based on the latest share price, the company has a market value of $203 billion. It's got $33 billion of cash and $23 billion of debt, so the enterprise value is $193 billion. Meanwhile, the company has reported $126 billion of revenue over the last 12 months, $19 billion of net income, and $27 billion of free cash flow. That means the stock is valued at 11 times earnings and 7 times free cash flow. To put that in perspective, if you bought the whole company today, you'd get your money back in cash in only 7 years. But Alibaba also has $79 billion of investments on its balance sheet. Take those investments into account and the valuation drops even further to $114 billion, which means the stock is valued at only 4 times free cash flow. Whatever way you look at it, Alibaba's stock is extremely cheap. The question is why? The key reason is China. Investors are worried about a hard landing, and problems at Evergrande suggest a potential property crisis. Meanwhile, the Chinese government has taken a hard stance against big tech. Alibaba has been fined on numerous occasions, and the IPO of Ant Group, in which Alibaba holds a 1/3 stake, was cancelled by regulators. China also prohibits foreign ownership in most of its domestic companies. That means when you buy Alibaba stock, you don't actually receive ownership in the company. Instead, investors own something called a variable interest entity based in the Cayman Islands. The VIE structure has a claim on the underlying assets, but investors fear the CCP could one day revoke that claim. And there are concerns about growth too. Alibaba's cloud business has only grown 3% in the last 2 quarters, which is much lower than US peers. Plans to spin the business off are now being put on hold due to US export bans on advanced semiconductors. Even currency has been an issue, with the Chinese yuan falling 8% against the dollar this year. But Alibaba is still a highly profitable and consistent business. Q2 total revenue grew 9%, with adjusted net income climbing 19%, and the company is now returning cash in the form of its first ever dividend. There are risks, but the stock is incredibly cheap, and management clearly wants to unlock value for shareholders. It's also worth noting the stock is owned by a number of well-known investors, including Charlie Munger and Michael Burry. Overall, it wouldn't take much to see a large rally in Alibaba stock, which is why I currently rate it a strong buy. But these are my personal opinions, not financial advice, and I do hold shares in the stock. To see more of my videos, visit my website at 3minutebreakdowns.com. Thank you for watching.